with Prabhudas Lilladher. Let's take a conversation forward. Amnish, good morning. Thank you for joining us. What do you make of yesterday's price action? Very sudden, very sharp. Do you think we've peaked out now in the short term?
You see, the market was actually overheated to some extent in, you can say, many small caps and several segments. So if you look at, say, past few months, the rally was, although the index was also moving up, it was led by small caps and mid caps, and many large cap sectors, they were not performing to that extent, or rather they were underperforming the broader markets. So my sense is that yes, there could be some more cut which can be there in the small cap, mid caps. But definitely, I think maybe say in the interim now, at least in the mid cap, small caps, there could be a pause, and the next leg of rally might be led by the large caps. That is what my view is.
At what level you would, in a sense, recommend your clients that they should now start putting money to work? Because there's a lot of FOMO in the market. I mean, one day of correction is not going to change the money which is on the sidelines, which is desperate to come in.
You see, there is no, I would say, timing the market has never been a good strategy or is possible. The main thing is that one has to be very, very stock specific, and when one finds that the stocks have come to more reasonable levels, then one can actually start buying, because this is not, I would say, the end of the bull market, or there is no change in the stance as far as the economy or the markets over the medium to long term are concerned. So very difficult to, you can say that whether one should start buying or few days down the line. I think it should be very stock specific, and when one finds that the stock has come to a particular level which is reasonable and good, one can start buying into the market.
Is reasonable, or what you would like to buy at 5-10% decline?
Yeah, Nikunj, is it for me?
Yeah, that's right.
Can you repeat again, please?
No, what do you think is reasonable, or where do you think 5-10% decline you're happy to buy it?
Okay, I think our sectoral calls don't change. For example, banks, if you look at, say, particularly the private sector banks, they have not moved up. Whether you look at, say, past 6 months, 12 months, they have been gross underperformers, and they still remain reasonable. So any correction in the private sector banks, so that can be, I would say, a good entry point. Then some of the, you can say, names in the capital goods, yes, they had rallied somewhere like, you can say, Siemens, ABB, or even some mid-cap names. So if they correct to, say, maybe another 10%, 15%, that they could be good picks. So similarly, some of the names in particularly your healthcare hospitality space, hospitals, they continue to look good, and a few names even in the, I would say, discretionary sides on which we have been very positive. So it is going to be very, very stock specific. But if you look at broader pockets, then in broader pockets, banks, hospitals, your capital goods, as well as some of the IT names, they could figure out in that list.
Amnish, do you like anything from the recent IPOs, which you like the business but you don't like the price?
You see, if you like the business, I think Tata Technologies was, I think it was a good IPO, although post-listing the stock rallied very sharply. Among, I think, if you look at, say, some of the other names, I think one IPO which is currently open, which is your brands. I think that is another company which looks interesting. It is coming at something like 23 times trailing earnings. But otherwise, I would say in IPOs which have come recently, I wouldn't be able to give any major names in that, because many of them post listing also they have run up quite a bit. So
Time to understand.
big names over there.
ADA, what's happening there?
Data, you see, again, if you are buying, you can say a company just because it is funding the renewables, trading at more than 3.5 times, I think it doesn't make sense actually, because the froth which is getting created today, you are getting the best of the private sector banks or the companies which have got much bigger balance sheets at 2.5 times, 2.6 times. So buying a stock at 3.5 times, like ADA, I think it doesn't make sense at the current juncture.
104 rupees, but remember it had become 120, but 32 became 120. 120 has become 104, so it is still 3x from the issue price per se. That is something which is worth noting.
What's your take on DLF?
Real estate as a space, we are very positive about. And I think the kind of turnaround which has happened in the entire real estate sector, that is going to last, because this is usually not a 1 or 2 year cycle. So the cycle has got reversed after 8 to 10 years, and I think the cycle is going to last. And DLF, being the large player and the formidable player, continues to look good, and one can actually look at DLF on declines.
Nuresh, if flows come back, will they come back into large cap stocks? Amnish, you look at the market from October and flows are back. But whether it was yesterday's price action or in last 40-45 days, HDFC Bank and Reliance, which in a sense are the flag bearers of FI ownership and flag bearer of FI activity, they've underperformed. I mean, FIs were not there, they were underperforming. Logical. There's logic in it. But FIs are back and then yet they are underperforming. It's difficult to connect.
That's what I was referring to, that the broader market was being led more by, I would say, mid caps. And if you look at most of the large cap names, so Reliance is one, HDFC Bank. Even if you look at, say, ICICI if you look slightly longer over the last, say, 12 months or so, even ICICI Bank hasn't done anything. So I would say it's a classic case that not only you see the markets in the last 6 months, it is not only the FI money, it is the money which is coming from, you can say, the SIPs, which is coming from the local PMS, AIF, that is, you can say, running the market. And when it comes to HDFC and Reliance in particular, I think Reliance is more like an event-driven stock at this point of time. It has undergone long consolidation, and the kind of initiative it is taking in new energy and some of the emerging segments, I think the major value unlocking is going to come from here. And that is why the stock has been range bound for some time. If we exclude the value which has been created under Geo Financials, the returns have been, I would say, moderate over the last 2 years. Similarly, the case with HDFC Bank, I think now the contribution to Nifty for this stock is also high, and the stock was, I would say, significantly overowned a couple of months back when the actually merger took place. So given the fact that these two stocks have got a considerable weightage and they have not performed, that actually makes the case that once they stop, when they start performing next year, there's a good probability that the large caps might outperform mid caps for some time.
Overnight,
Do you think this entire PSU juggernaut will continue to roll, or it's time now to jump off the train?
See, if you look at, say, past 3-4 years, the data for which has been shared, so a lot of uptick has actually come from, one is clearly the banks. The second is you can say, railway stocks. And as far as your oil companies are concerned, I think depending upon the oil prices, they continue to, say, move up and down. So I think in some of the segments where the PSUs are still playing, for example, the railways, the defense, or some of the newer names, I think there could be, say, still run up in the long term. But yes, it will not be possible to replicate the kind of returns we have seen in the past couple of years. Whether these are stocks, you can say, on the railway construction side, whether these are defense PSUs like your HAL, BDL, etc., they will continue to give you secular returns from here. But definitely, it might not be possible for each and every stock in the PSU basket. Similarly, if you look at the banks in particular, the PSU banks, they are still trading at, you can say, less than one price to book. If their books continue to be the way they are, if they continue to further upgrade their technology like they have done in the past few years, then the very fact that there is likelihood of now further consolidation of PSU banks, then the further uptick in the price to book of PSU banks can't be ruled out. But now the return should become at a more reasonable rate and not like some of the stocks we have seen actually going 3x, 4x in the last 12 months, but that might not repeat.
the word coming in as far as the PS.
Amnish, why is IT doing well? I mean, Accenture numbers were not that impressive. There's nothing very great about what we've heard from many of the IT companies in terms of where they see IT demand is moving. But the index has given 20% return. Normally, when the index starts, IT stocks, they start outperforming when the sector is on a turn in terms of going higher. So what are markets excited about?
I think as far as your fundamental performance is concerned, there is nothing much to excited about as of now. It might take, say, at least a couple of quarters. I think the recent run-up in the stock prices has happened on account of two things. One is primarily the hope that there might be some interest rate cut in the US market. And secondly, the IT sector, if you look on a very broad basis, all the large caps, they have significantly underperformed most of the indices and most of the other stocks. So these two factors have actually led to that. It's more like that when everything else has moved up, then people start looking for stocks or the sectors which have not moved up. And that is where IT sector has come in, and valuations there, they are not like what they had gone in the 2020-21 cycle. So post first wave of COVID, the way IT sector got re-rated, even today, despite growth being low, their valuations are significantly lower than that. And I think these two factors have led to, you can say, a sharp pickup in the price of some of the IT stocks in the last, say, 10 odd days.